Morning, good afternoon, good evening to everyone, and welcome to this side event of the High-Level Dialogue on Energy, where we'll focus on ramping up the engagement of local financial institutions, or LFIs as we call them, in lending for energy access. So thanks for joining us today. I'm Cliff Aaron, one of the founding principals of GreenMax Capital Group. GreenMax is the sponsor and fund manager for the Green for Access First Loss Facility, known as G4A, a new risk mitigation facility to partner with local financial institutions in Africa to scale up local currency debt financing for energy access. We're thankful to the High-Level Dialogue on Energy team for selecting us to present this event, and also thankful to all of our panelists who will be speaking today from the G4A team and various PAYG solar companies and mini grid developers. We've developed G4A with 4 basic premises in mind, and we hope we will convince you today that LFIs should play a critical role in meeting the SDG 7 finance challenge. Those premises: first, energy access funding needs in Sub-Saharan Africa simply can't be met without leveraging in private capital, and LFIs are one crucial part of the private capital ecosystem. Second, currency exchange risk creates huge exposures for distributed energy service companies, and LFIs are best suited to provide local currency finance. The off-grid sector is overburdened with on-balance sheet financing. LFIs can provide direct consumer lending to PAYG customers to help relieve this burden. And finally, African-owned energy access companies have struggled to raise capital, and LFIs are a natural match to finance companies from their own countries. Our agenda today will be as follows. After my introduction, our first panel will be presented by my G4A colleagues, Koye Alaba and Ezine Okafor, who will describe the Green for Access First Loss Facility and how it will help to scale up LFI lending for energy access. Our second panel focused on the financing needs for PAYG solar in Africa will be joined by Anton Espira from Cilibrium Solar in Kenya and Natalie Casey from Coolbox. And our third panel will be financing needs for mini grids in Africa with Henry Ure from Darwe Coast in Nigeria and Prosper Magali from Ensol in Tanzania. So we wish you a good experience this morning, and I turn it over to my colleagues, Koye Alaba and Ezine Okafor.
Thank you, Cliff, for the introduction. Hi, everyone. My name is Ezine Okafor, and I'm talking to you today from Lagos, Nigeria. So I'll be taking us through a few slides which discuss the energy access financing needs, the role of local FIs in meeting the financing challenge, summary of some findings from a G4A market assessment survey, and G4A solution. Local financial institutions play a critical role in meeting the SDG 7 financing challenge. First, energy access funding needs in the region cannot be met without leveraging private capital. Secondly, due to currency volatility and FX risk, which poses huge exposure for distributed energy service companies who earn most of their revenue in local currency, but receive most of their financing in hard currency. As such, the local FIs are most suited to provide local currency financing. Third, the off-grid sector needs off-balance sheet funding, and local financial institutions can provide loans directly to the end-use customers. Fourth, over 90% of the financing flowing into the Sub-Saharan Africa off-grid space goes to internationally owned companies. And this is inequitable and also unsustainable, as it is the African companies who are best suited to serve last mile customers. Therefore, mainstreaming energy access funding through local FIs can address these challenges. Next slide, please. Now, let us quantify the energy access financing needs in Sub-Saharan Africa. According to a 2019 Africa Energy Outlook report, achieving electricity access for all in the region by 2030 and maintaining it to 2040 requires $102 billion yearly. This includes $18.8 billion for green mini-grids and standalone systems. Another study by Catalyst Advisors shows that mini-grid and SHS investments for universal energy access by 2030 requires about $33 billion. Now, a recent study by GreenMax estimates the cumulative off-grid financing for universal access in the region up to 2030 to total about $99 billion. Next slide, please. Now, from the GreenMax survey, GreenMax Market Assessment Survey, it was found that local financial institutions in Sub-Saharan Africa are willing to lend up to about $6 billion for energy access initiatives. However, these financial institutions require technical assistance support for off-grid lending, as up to 68% of them identified collateral inadequacy as a key barrier to lending to the sector. Next slide. A first loss cash reserve instrument will increase lending, and it will also reduce the collateral requirements of the financial institutions by up to 42%, as indicated by the respondents. Now, this is important for indigenous or locally owned companies who are mainly affected by these high collateral requirements and could become the main beneficiaries of this funding. The actionable deal pipeline for these local companies sums up to about $269 million. Next slide, please. The challenge. Local financial institutions remain largely untapped, as we see from data gotten from local financial institutions across the 15 G4A countries from the survey taken in December 2018. Some of the challenges that hinder off-grid lending by local financial institutions include concerns about the credit quality or ability to pay of the end-use customers, concerns over undercapitalization of the off-grid businesses, low understanding of the off-grid sector, the business model and the risks, unfavorable loan tenors, high collateral requirements and high interest rates, and the generally risk-averse nature of these institutions. This slide also shows a few quotes by some stakeholders in the energy access sector, such as the Global Distributors Collective and the Africa Mini-Grid Association, AMDA. And these quotes highlight the importance of local financial institution financing from the off-grid sector and its ability to change the game. Next slide, please. About 95% of the funding raised till date by energy access companies active in this region has been by internationally owned companies, which sums up to about $1.53 billion compared to $773 million raised by locally owned companies. This shows the huge mismatch between the funds flowing to international companies versus the local companies. Next slide. G4A solution. G4A solution is a first loss cash deposit fund product that is focused on providing stronger than usual credit enhancement and technical assistance to qualified lenders such as financial institutions and microfinancial institutions. This support will enable them to provide local currency lending to the energy access sector. Now, G4A will provide a maximum cover of up to 20% of losses in a portfolio of energy access loans. The deposits of up to 20% of the projected loan portfolio will be placed in a specialized account known as the Cash Deposit Fund, or CDFs for short. will be domiciled at a partner financial institution and will be available to draw on to cover losses up to the amount in the CDF. G4A will also provide the technical assistance support needed to partner financial institutions and off-grid companies with quality deal pipelines who are applying for financing. And G4A will help to facilitate these partnerships between the FIs and the developers or the companies. I will now hand over to my colleague Koye, who will discuss and explain in detail how the CDF covers losses and how far we have gone in the G4A. Thank you.
Thank you, Ezine. Hi, everyone. My name is Koye Alaba, and I'll be providing a little more detail on how G4A's solution works. So this slide shows a practical example of how the CDF will cover losses in comparison to existing pari passu guarantees. So assuming a local bank originates a $10 million energy access loan portfolio in local currency, of course, and assuming that there is a total default of $2 million in the portfolio, a typical pari passu guarantee providing 50% coverage will only cover $1 million of losses, while the bank will have to bear the remaining $1 million. However, with G4A providing 100% coverage on the first 20% of losses, in this example, G4A will cover the entire $2 million default, since it is within the limit of coverage and there will be zero loss to the local financial institution. Next slide, please. So G4A will provide cover for two types of lending structures, namely consumer loans and project finance. Under the consumer loan structure, G4A will provide first loss cover to FIs lending directly to households, MSMEs, farmers, health clinics, and agribusinesses. While under the project finance structure, G4A will support banks to provide loan facilities to mini-grid portfolios. Next slide. Now, this diagram shows how G4A will support lending under the consumer loan structure. Under this structure, G4A will provide a cash deposit facility to a local bank to cover up to 6 months of arrears on each portfolio loan before it is called into default. And also, we would provide 100% coverage of principal upon default on a first loss basis up to the CDF limit of liability. And then the PAYG company, in partnership with the local bank, will originate contracts with consumers. Then the bank would pay the PAYG company for installations from the loan proceeds. The bank will hold a retainage from the loan to ensure that the company fulfills its obligations to provide O&M services, and most importantly, to repossess and resell the solar system in the event of a customer loan default, which serves mainly as the main source of loss recovery. And then the bank will be responsible for managing the loan portfolio and will also pay fees to G4A for the risk coverage provided. And this would allow G4A to cover its costs and to provide a modest return to the funders supporting the facility. Next slide, please. Now, the second type of loan structure that we would support is displayed on this diagram. And it illustrates how G4A will support lending to mini-grid portfolios. So G4A will not underwrite individual mini-grid projects on a one-off basis. Rather, mini-grid developers will be required to aggregate their mini-grid projects into portfolios under an asset co. And the asset co will enter into agreements with the developers to build and operate and maintain the mini-grids. And G4A will then provide cash deposit facilities to the local bank to support lending to the asset co for the construction of the mini-grids. And the cash deposit facilities that we will be providing to banks lending to mini-grid portfolios will be in the 7 to 10 year range, as against 2 to 3 years for PAYG solar portfolios. Next slide, please. So in terms of our fee structure, the partner banks will be charged an annual facility fee in the range of 1 to 2% on the full amount of the cash deposit facility. Also, the CDF will be placed in an interest yielding USD account. And there will be additional fees on withdrawals made from the CDF. And these are to be discussed with the partner banks. Next slide, please. Now, moving on quickly to the structure of the fund. G4A has been designed as a 12-year closed-end fund with a total capitalization of $50 million, comprising of 3 tranches of capital, namely a $20 million senior debt tranche, which we expect will be provided by DFIs and private impact investors, and then a $20 million concessional junior debt tranche, which we expect will be provided by philanthropic and public funds and private high impact investors. And lastly, a $10 million grant tranche, which will be provided by philanthropic funds as well. Both the senior and junior debt providers will only get interest payments, and they would get the return of principal at the 12th year of the fund after liquidation. And this is to allow for maximum impact through continuous redeployment of capital over the 12-year horizon of the facility. And in terms of interest, the senior lender will receive annual interest payments at 4% per annum, while the junior lender will receive annual interest payments at 2% per annum. And the yield on the junior debt is lower because we expect that it will be provided by philanthropic funds most concerned with capital preservation and impact. And in addition, we believe that the cushion provided by the grant tranche and the 80% first loss guarantee to be provided by CEDA on the junior debt will make the concessional terms acceptable. And the full $50 million facility will cover the 15 target countries shown on the map on the right, which were identified during our market assessment. And in addition to the $50 million facility, an additional $5 million grant is needed for a parallel technical assistance facility. And GreenMax will serve as the fund manager with an annual management fee of 2%. Next slide, please. So due to the long time it takes to reach financial close for a fund entity such as G4A, we have set up pilot CDFs with 5 FIs and 1 MFI to serve the existing pipeline of deals that we've already identified. And each pilot is being organized as a standalone CDF and an individual investment opportunity, which will be rolled up into the full G4A facility when it is launched. The total funding needed for the pilots is about $4.3 million, which would catalyze about $21 million in energy access loans. Next slide, please. And in terms of impact, the $50 million G4A facility is expected to catalyze nearly $900 million in local currency denominated energy access loans in Sub-Saharan Africa, provided by local banks over its 12-year life. And this will translate to an overall leverage ratio of about 18 times and the deployment of 2 million off-grid energy systems with a total capacity of about 175 megawatts. Next slide. So thank you for listening, and please get in touch with us at these contacts and support us as we bridge the energy access gap in the region. I will now turn it back to Cliff to introduce the next panel session. Thank you.
Thanks a lot, Ezine and Koye. If there are any questions in the chat box, we can take a couple of quick ones before moving on to the next panel. Or we can, of course, take questions at the end of the event. Okay, I don't see anything in the chat box, so let's go ahead with our next panel. So let me welcome our colleagues Natalie Casey from Coolbox and Anton Espira from Celebrium Solar. Coolbox is one of our G4A partners in Nigeria. They are a provider of cold storage technologies that are solar powered, and they've been offering these on a pay-go basis. Celebrium Solar is an offshoot of Equilibrium, which is one of the primary last mile distributors in rural areas in Kenya. So thanks, Natalie and Anton, for joining. Natalie, why don't you start and just give a little bit of background on Coolbox, and then Anton, you can follow.
Sure. Thank you so much, Cliff. So again, my name is Natalie Casey. I'm the Chief Business Officer at Coolbox. And at Coolbox, we've developed a solar-powered refrigerator freezer system that's based on thermal cooling technology, and it stores solar energy in the form of ice batteries, which then cool the contents of the freezer. Our freezers can be used for productive use, primarily for small businesses, or for healthcare use as well for vaccine storage. And each fridge is pay-as-you-go enabled to facilitate asset financing to the end customer. And our healthcare fridges are also enabled with real-time temperature monitoring and an alert system if the fridges deviate from the programmed temperature range. So we offer innovative financing solutions with our PAYG platform to enable greater access to refrigeration, including lease to own as well as cooling as a service agreements. And with these agreements, we are addressing the high upfront costs and enabling greater access to our refrigeration systems. So Anton, maybe I'll pass it on to you.
Yeah, thank you, Cliff. Thank you, Natalie. Celebrium is a standard last mile distributor based in Western Kenya, and we operate throughout Kenya. We sell solar home systems to our rural community partners, as well as productive use systems to small entrepreneurs in the communities we work in. Most of the systems we sell are on the standard pay-as-you-go model, which is pretty popular and everybody knows about it. But as we grow the productive use solar portfolio, we are starting to explore other alternatives for payment, including things like what Natalie just mentioned, the lease to own systems. As the earlier presentation highlighted, a challenge for us remains raising sufficient capital to grow the company, because we are a local company based and operated in Kenya. There is a lot of increasingly sophisticated financial tools that support off-grid solar access, but most of these tools are built for larger multinationals that have the depth of capabilities to apply for these tools and to service the loans that these tools support. So it is long overdue that we get some support from local finance institutions.
Great, thanks. So Natalie, maybe you could describe for us a little bit about Coolbox's efforts to secure finance on the local markets that you're working in.
Sure. So and we've primarily been focusing on the Nigerian market. At the beginning of this year, we launched a pilot where we included, as of now, up to around 80 customers on the lease to own through pay as you go. And so we've been using primarily our own funds for that. We're in the process of fundraising and with some challenges to access working capital prior to raising our first equity raise through a seed round. So we had actually tried to work with a local financial institution to be able to finance some of the assets to the end customers with some success, but still some challenges as well related to being able to sign up new customers following the bank's KYC process, and also just speed to be able to react to the consumer demand. And so that really made us think about maybe running the pilot on our own, which then leads us to a challenge of having enough financing for our working capital requirements to be able to serve those customers as we move out of this pilot phase into more of a scale-up phase. So I think that this type of facility could be really, really catalytic for us in the sense that it would address some of the challenges that we've seen from local financial institutions that we would want to partner with to be able to fund those that portfolio of clients. And it was interesting because all of the points that were mentioned from the challenges to LFI lending earlier in the presentation, I think we've heard that from each of our partners, just some of the hesitation around lending for PAYG solutions. So it could really be a way for us to unleash some of the potential in the market to be able to grow from our pilot to something that's more substantial.
Great. And Anton, I know you've had some frustrations in trying to work with local banks in Kenya. So why don't you tell us something about that?
Yes, indeed. So when the solar market was younger several years ago, the funding that was available internationally came with terms that were significantly more friendly than funding that's available locally. But as the market has evolved, we're finding that the terms on international funding are not very different from the terms on local funding. However, so we're facing the same kind of interest rate, the same kind of need for collateral and etc. However, local partners are still very hesitant to lend to the pay-as-you-go sector because they understand the market and they understand the risks that are involved. So without support for local financing institutions, without some support for them to mitigate that risk, I think the hesitation will continue. The general tendency with local financing institutions that we have approached has been a request for sufficient collateral, either in physical or in cash form, to support a loan. But ironically, if we have enough cash to put down as a collateral for a loan, then we do not actually need the loan. So we're stuck in that circular situation. And as much as LFIs want to support us, they're quite candid that the risk on our customer portfolio is too high. And without some kind of backup, they would be hesitant to do that. But they already, I mean, as we move up the scale of solar home systems, from the smaller lanterns to the larger systems with refrigerators and televisions, the cost of the systems keeps going up. And I think this creates an ideal new opportunity for LFIs to actually step in, because the customers who are ready to finance the larger systems are also likely to already be involved in local banking. They're likely to have small bank accounts, be it mobile or in physical banks, etc. So I think the time for LFI partnership is really coming close.
Great, thanks. And Anton, as you scale up into refrigerators, let me introduce you to Natalie.
I already took note of that. So. Yeah, there's some innovative products out there. So I was just reading about Coolbox, some really nice innovative products. Yeah.
So I know, Anton, you've kind of described that the LFIs you're talking with are pretty sophisticated about lending to rural customers, but the main barrier has been risk perception. Natalie, have you found the same thing in Nigeria? Are the banks interested and willing and sophisticated in this market, but really the challenge is their high perception of risk?
Yeah, thanks for the question. Certainly there's a high perception of risk, as well as a very already very well developed KYC processes, which the banks are accustomed to follow. And so oftentimes we find that our customers, even if they may already be small business owners that are operating well and have enough income and resources to be able to make their monthly payments, they may not meet the KYC requirements in terms of documentation or having a bank account. And so I think that there's really a challenge in understanding how we could possibly make exceptions for those customers. And I think perhaps an alternative would be, as was described earlier in the facility, to have those kind of customer selection that be the responsibility of the manufacturer and the provider. And so in a way, the banks would then be offering a working capital facility to the companies, and then let the companies select the customers to be able to offer that credit. So I think that some of the challenges have been around really just the customer base qualifying under the constructs of what the banks are looking for to be able to provide credit.
Okay, and it's interesting that you've described desire to have on-balance sheet finance from a local lender and local currency. Many of the companies we've interfaced with in the PAYG space, particularly the smaller startups and the LMDs, have suggested that, well, that's a major constraint on our growth. If we have to take debt on our own balance sheet, wouldn't it be great if we could get the FIs to do direct consumer lending to our customers and we just implement and operate projects?
So absolutely, I think it would be it would actually be better to have the off-balance sheet financing, but the challenge I see is really in ensuring that the loans are being created, in the sense that I question whether the financial institutions would want to have the responsibility of finding the customers, signing them up, potentially repossessing the asset if that was required, and I think that the companies might be in a better position to handle all of the activities related to that, and so the piece of creating the loans to the end customers, that is a critical part of the commercial process. So when the company finds a customer that is interested in the product, that seems to be qualified, would be able to make the payments, the disconnect would be, would the financial institution, would that customer be able to go through all of the processes of the financial institution, and would it be worth the effort for a lender to do that for, say, a refrigerator or for a solar home system? So I think that's really it. if we could solve that piece, to have the best of both worlds, I think that would be ideal.
Yeah, well, that's the goal of the G4A facility, is to help lenders develop the processes in partnership with PAYG companies so that there can really be a quick and seamless consumer finance transaction. We found that many of the banks that we've entered into agreements with have the foresight to see rural and peri-urban customers as being their big opportunity for growth in the future, and solar and solar appliances being like a first foot in the door if they can get over the risk perception. So we're trying to partner with them on that basis. Anton, what's your thoughts about on-balance versus off-balance sheet finance, and how important is that for your company?
I mean, both options work pretty well. We are coming to a stage where the solar products being sold are valuable enough to start being interesting to local finance institutions. I mean, particularly to microfinance institutions. So off-balance funding is becoming more and more of a possibility. If you look at local microfinance institutions, they do support loans to purchase, to buy a cow for $500 to $1,000, to buy a car for $1,000 to $2,000, which is about the cost of a new and sophisticated solar home system that includes a refrigerator, television, multiple lights. So I think, I mean, from our point of view, for growth, off-balance funding is not particularly ideal for growth, but it does de-risk us and it does give us enough leeway to work. But if that's the best way that we can attract local finance institutions, then we're happy to do that. Commenting on something that has been mentioned a few times, we found that local finance institutions already have the network for repossession in many cases. They already have the tools for assessing the credit worthiness of customers. Those are things that we don't have an expertise in. So if we can find a balance between both worlds, just like you said, where, as Natalie suggested, we do the selling and the selecting of the customers, and the banks provide the funding, and then take the customer from there, that would be an ideal situation.
Great. So we're going to close this panel. I ask again if anyone has some questions for our panelists to put those in the chat. I don't see any questions right now, so we'll go ahead with the next panel, which is focused on the same set of questions, but specifically for the mini-grid sector of the off-grid ecosystem. And mini-grids pose a very different kind of finance challenge. I'm told that unfortunately one of our two panelists hasn't joined us yet, so we'll start with our colleague from Darway Coast, Henry Ura, which is one of the main Nigerian-owned mini-grid developers, working to develop and build and operate a portfolio of over 100 mini-grids in rural areas of Nigeria. So Henry, why don't you give us some introduction to the work of Darway?
Yeah, thank you, Cliff. Hi everyone. My name is Henry, as Cliff mentioned, with Darway Coast. So Darway is more or less a renewable energy developer that focuses on underserved and unserved communities, primarily starting off with Nigeria. We've been in operation. We started in 2000 and we registered in 2015, but commenced operation in 2017. Currently, we have 4 operational mini grids, and we have about, like Cliff mentioned, give or take about 90 or thereabouts at different stages of development. A few of them are in construction. Some of them are more or less going through financing phase where we are near closing financing. And while some of them are also in the development phase, going through the permitting and the likes. And overall, we've been able to make some progress in the mini grid space by partnering with the right partners, like the distribution companies, forming a good relationship with the regulatory structure, the regulatory personnel in Nigeria, and also with the Rural Electrification Agency in Nigeria that's been doing quite a bit of great job, I would say, in promoting off-grid electrification in Nigeria. So at Darway Coast, we can ask for any, this, I would say, a program like this or facility like this couldn't have come at a better time. It's definitely needed, and I'm excited to be, having this type of conversation to move the off-grid space forward.
Great, thanks, Henry. So, Nigeria, of course, is, oh, I see Prosper has joined us, great. So, hi, Prosper Magali. Prosper is one of the founders of Ensol, which is a mini grid developer in Tanzania. Prosper, could you give us a little bit of background on Ensol and your activities?
Thank you so much, Clifford. Sorry, I've been a bit late to join. As introduced, I'm Prosper Magali, one of the owners of Ensol Tanzania Limited, established in about 20 years ago. We basically focus all dealing in the EPC space for the renewable energy technologies, supplying and installing renewable energy solutions for private and public institutions. We also do mini grids. And since 2017, we have commissioned already a 50 kilowatt mini grid connecting 300 customers now as we speak, and over 20 other projects in development stage. So we are really active as well in that segment. As well, the chairperson for Tanzania Renewable Energy Association, which is the umbrella association of renewable energy actors in Tanzania. So we so much deal in advocacy and the other activities which are needed by our members. So thank you so much, Clifford, for this opportunity.
Great. Well, Prosper, 20 years as a mini grid developer, that makes you the grandpa of the African mini grid sector, I think. That's quite a history. Turning back to you, Henry, Nigeria is kind of the laboratory for scaling up the implementation of mini grids on a large scale. And of course, there's the Nigerian electrification program funded by the World Bank and AFDB and implemented by REA that provides results-based financing. And as we've understood from REA and from the bank, one of the real challenges with scaling up the NEP quickly has been to generate debt financing opportunities for the mini grid developers that qualify for the RBF. So maybe you could say a few words about that, and also how important securing local currency finance is for the success of your business.
Yeah, thanks, Cliff. So the securing finance, especially for mini grids, has been, for lack of a better word, quite challenging, I would say. Initially, like you said, the RBF result-based financing was, I would say provide quite a bit of incentive for financiers to play in this space. But initially there was this skepticism, amongst financiers that if the program is real, or is this another gimmick out there. But overall, I feel the ROA has done a good job in sensitizing local financiers and international DFIs as well. We're starting to see more of them warm up to the space, although not at the pace as we would like them to, especially if we really want to scale the deployment of mini grid. But the SHS segments has done far way better than the mini grid segments, just because of a lot of these challenges. The capital requirements for mini grids and the likes. One of the resentments, or one of the reasons local financiers have been shying away from this would be, one of their perception of the ability of customers, the off-takers, to pay. They definitely don't consider these customers bankable, and they tend to use the typical credit risk criteria for other types of projects for mini grids, which mini grids for large extents cannot survive such type of credit risk criteria. And also the tenor, just like the presentation earlier has described, trying to expect the return or payback period of mini grid in such a short amount of time definitely is not possible. And coming up with innovative financing structures like the G4A, and also some sophisticated project financing structures I've seen out there is actually what is needed to actually bridge that gap of financing mini grids and actually getting local banks, financial institutions involved in this. For instance, not basing it on the balance sheets and also collateral requirements. If the local financial institution can back away from that and look at this from a pure project finance standpoint, and also leverage on not only the cash flow, but in this case also the subsidy being provided, I think it provides quite a bit of comfort, I would say. And also the G4A facility also, this is, in my opinion, actually very, very needed, in pushing this forward, because the traditional means of, assessing, debts proposal cannot be used for mini grid. Hence, the need for such innovative, instruments like the G4A and also the result-based financing should be taken highly, into consideration when assessing proposals, to finance mini grids.
Thanks, Henry. Prosper, what's been your experience in trying to deal with local lenders for your projects in Tanzania? I know there's been a World Bank guarantee facility, but hasn't had huge success for some reason. So can you talk a little bit about that experience?
Thank you, Cliff. First of all, I think it's better for the audience to know or to understand that money or finance is available. There is plenty of money in the global market, but as well as in the local, different local markets. For example, here in Tanzania, the World Bank fund that you have mentioned, I understand it's still available, but not quite well tapped by project developers. There was another fund sitting in a different bank, in the Bank of Africa, specifically for renewable energy, but that was as well not well tapped by project developers. So the money is actually there. The money is available, but the biggest challenge has been the conditions actually to access the money, the finance. As Henry mentioned, one of the very bottleneck is the requirement for collateral. The requirement for collateral, that has been the biggest bottleneck for Tanzania, I understand, because the finance was arranged to be given out following the traditional way for the local banks to give out their finance, not like the project finance kinds that we want for our projects. So that has been the biggest challenge. But I think the other factor which is very key is the general knowledge of our financial institutions of the sector. So as Henry mentioned, financial institutions still perceive our sector to be so risky, which is actually true. We know that the ability to pay for our customers is quite low. There are a lot of other risks as well. The market is considered to be not stabilized yet, and it is considered to be a small market. Some of the other factors include ticket sizes of our projects. Most of the time we present on the table small ticket size projects, while some of them are interested in big ticket sizes. So these have been the challenges. Our projects also need a long tenure of finance, while most of the financial institutions prefer short tenure of projects. So in my experience, I think those have been the biggest challenges for local developers or for developers in Tanzania to assess the finance. And I believe now that initiatives like the G4A would now come to try to fill that gap.
Right, and at G4A, we've recognized that it's a dual problem, one of education and capacity building at the FIs to help them to structure deals appropriately to finance the mini grid sector, as well as to cover losses through a risk mitigation product. Henry, I know that you're one of the few mini grid developers in Nigeria to actually, go through a negotiation with a local financial institution. So tell us a little bit about that experience.
Yeah, so it was quite intense, I would say. We've had negotiations with one would be like infrastructure finance, or considered like an infrastructure finance type of organization, and the other would be a local bank. And for the local bank, it was kind of interesting because they really had to. I have to give credit to the managers of the renewable energy desk at that local finance a local bank, because they really had to educate the credit risk committee about the space. Actually, in a way, first of all, they had to educate themselves, then in turn educate the internal committee on how to assess or how to assess this type of facility. And in doing so, they were able to come up with what they call the product paper that was just tailored to the mini grid, the RBF program. Although not definitely, it's a good start. I would say it was a very good start in the sense that the requirements were tailored for that particular program. And just everything about the product paper and the facility was tailored for that program. But then again, there's a bit of limitation on the amount of money that you could raise, you could assess with that program. So in my opinion, I thought that was a good start, but a good model for other banks to follow, get that comfort, and then hopefully that will help scale, as opposed to not even trying at all. So that particular FCMB, they were quite innovative in that sense. Then on the infrastructure finance organization that we're dealing with, they have more risk appetite, I would say, just because the way they've structured this, and the RBF definitely did play a major role in providing comfort for them. And us, working along with them, being that they've done a transaction before, actually did make it a lot easier. And then having advisors, the likes of GreenMax, definitely did help. But overall, I think such financial institutions, infrastructure finance institutions, should be another avenue to help push this type of mini grid financing or energy access financing forward, because their model is definitely very different from the likes of the local banks. They look at it as a pure project finance with no collateral requirement and the likes, but they do require some comfort. So in that sense, I would say there's a lot of progress being made. However, we still need other institutions to come on board, not just 2 or 3. We need more competition in the space. So there's been some progress, I would say.
Okay. And Prosper, during your 20 years of existence as the grandfather of mini grids in Africa, how have you been able to cobble together finance for building mini grids?
Unfortunately, it's really sad to say that we have been finding or assessing our finance outside of Tanzania because of the reasons that we've given out for the local financial institutions not to have the appetite to finance the sector. So we have relied on the international market for finance. Now, the challenge for that is you actually get the finance from using the hard currency, while you transact locally using the local currency. So that has been a huge challenge, and actually it is leading to make even our cost, to increase our cost of doing business. it is also making our prices to also be volatile depending on the fluctuation of the currency. So it has been a huge challenge actually to get finance in hard currency and transact in local currency. I know that this is one of the challenges that G4A is targeting to address, making sure that local companies are actually getting their finance using the local currency.
Great. I want to open the floor up to questions. Again, please put your questions in the chat box. I'm not seeing any questions so far. So what I'm going to do is I'm going to do a closing round with all four of our panelists from both the mini grid sector and the solar home system or productive use of energy sectors. So Natalie and Anton, if you could join us again and just ask each of you the question, starting with you, Natalie. In an ideal world, what kind of financing and what order of magnitude financing, over the next, 2, 3, 4 years would make the most sense for your growth?
Oh, that's a great question. I think where our greatest need right now is, and in the near term will be financing for working capital, whether that be on balance sheet, off balance sheet, but really to help us be able to provide access to our customers, the customers that we've identified. And we see that there is a lot of demand. So from the commercial perspective, our biggest challenge is having enough inventory to be able to meet that demand. We know that there are customers that are also credit worthy and just haven't been able to access our products because the upfront costs have been prohibitive. So I would say in the near term, we're looking at several million US dollars or euros to be able to support our growth projections in Nigeria. And as we think about expanding in other geographies, that number, of course, would go up accordingly.
Okay, and just some sense of how many customers that would serve.
Yeah, so I think our plans in the near term are in the order of 4,000 customers for the next year.
Okay, I mean that's great, but we also have to realize what a small, I mean it's amazing if you could reach that goal, but in the bigger perspective, what a small sliver of the total demand and total need that represents. So we need a lot more than a few $1 million, and wish you a lot of success in trying to scale up. Anton, same question to you. What's the ideal world scenario for you over the next few years?
Well, short of money just falling from heaven into our bank account tomorrow, that would be best way to do this. But exactly what Natalie said, whether it's off balance sheet or on balance sheet, and our primary challenge remains just like with Natalie's group, getting enough capital to fund the purchase of inventory, because pay-as-you-go products are sold on a pay-as-you-go basis, we get returns for everything over a 6 to 18-month period, sometimes 24-month period, while we have to pay upfront for the products to manufacturers. So we would need between $1 million to $2 million a year over the next 3 or 4 years to really meet the demand that we see among our customers. And if we were put in a corner, probably off-balance financing would be a very good way to go, because we have a lot of interest from people as we expand to the more underserved areas in Kenya, far from all the large cities. But many of these people don't have any access to finance to pay initial deposits or so on and so forth. So we can easily bring the customers to the table if we can get a finance partner who can help the customers to afford to purchase the units that the customers want.
Great, thanks. And again, for you, Anton, how many systems a month are you able to install?
So it's a simple calculation. If you do roughly $1 million, you can estimate about 10,000 units. So yeah, it's a simple calculation. So 10,000 customers for every $1 million. Yeah.
Okay. So now turning back to the mini grid sector, same question for you guys. What kind of finance facilities, what order of magnitude are you looking for over the next several years? Henry, go first, please. Yeah.
Sure. I would say from an interest rate standpoint, perhaps single digit. I know that's a tall task to ask for in Nigeria, considering the inflation, but perhaps low double digits / single digits will be ideal. Longer tenure of give or take at least 6 years or higher, or 5 or higher, I would say. And from a money or financing standpoints, we're looking at give or take over the next 2 to 3 years, 25 million and higher, and that should be able to energize well over, I would say, looking at perhaps $450 thereabouts to $500 per connection. We should be able to energize quite a number of connections using with about 25 million or higher. Yeah.
Great. And when you say low single digits, you're talking about it in local currency, in Naira.
Yeah, in local currency. Yes, not yeah.
And 5-6 year tenors can work for you.
Yeah, with grants, you're probably looking at about 3 years. Without grants, probably looking at about 7 years. Yeah.
Okay. Prosper, same question for you.
Thank you, Cliff. For Tanzania, I think, first of all, we need to get back our policies properly. It has been a bit of a challenge for the past 4 or 5 years to implement mini grid projects in Tanzania. So we are really working now. We have the new administration in the government. We are really working to bring back the proper policies in place, which we are really positive that we are going to succeed, and it's going to take us maybe 6 to 1 year from 6 months to 1 year from now. So already we have over 20 projects to develop, which would eventually connect about 10,000 connections, new connections, and it is a budget of about $4 million to be able to do that. And actually, it is a mix of different kind of financing tools, a combination of maybe equity as well as grants and a small portion of debt. So that is what we are looking forward in the next maybe 1 year to be able to raise and connect that number of new connections.
Great, thanks, Prosper. So between our 4 small businesses here, there's a need for between 30 and 40 million dollars in finance over the next couple of years. And in our opinion, small businesses are the true driver of energy access and meeting SDG 7. And there are at least several hundred of companies like the 4 that we've highlighted today, all of which are either founded and owned by Africans or by African expatriates in the U.S. or Europe, and these are the companies that need to be backed in order to achieve what we're all after. Again, I ask for any last questions from the group. I don't see any, so that means that our presentations have been incredibly engaging and thorough, and leave no need for questions. So I just want to sum up by saying that I think we've tried to highlight some of the financing needs of the sector today, how local financial institutions really need to step up and play a major role, and how a risk mitigation and technical assistance intervention like G4A, and we're not the only type of this facility being developed, but there's a tremendous need for this kind of engagement in order to deliver the finance that the sector needs, and we're trying to do our part. So I want to thank our audience for sticking with us today, and I want to thank especially our panelists and the G4A and GreenMax teams for putting this together. So wish you all a great and productive rest of the HLDE week. Have a great day, everyone.
Thank you.
Thank you. Bye.
Thank you.